Got basically an hour here to get through the content, so we've got a couple of speakers from AQR that are going to be taking the lead on the session today. So we got Yao Hua and Dan Villalan from AQR. I'll let each of them do basically introduction in terms of what their roles are at AQR. Again, thank you all for being here today. So we're basically going to have two parts today. So Yao Hua is basically going to speak to the style premium side of things, which will be a big portion of the presentation. Today, obviously, we know it's been a difficult period from a performance perspective over the last 18 plus months. So Yao Hua is really going to dig into what we've seen there from a performance perspective, kind of put that performance in a larger picture historical context. One thing I'll note for any of you that have used the fund and client portfolios, you'll see a lot of the content is focused on the LP limited partnership version of the fund, which has existed for a little bit longer, gives us more live data to look at. So some of the numbers might be a little bit different than what you would see with the fund, but I think it helps bring out that longer term perspective here. So again, that'll be the first part. We wanted to spend a significant amount of time there. I know not everyone in the room has used the fund, but for those that have, again, the last year and a half has been really challenging. We've had a lot of client and advisor questions about that performance period, so we really want to be able to dig into that. Then we'll hand off to Dan. Dan is going to take things up basically a little bit higher level, kind of look at this question of what does owning an uncorrelated alternative strategy look like? A strategy that has modest risk-adjusted returns to good risk-adjusted returns over time. What does that tend to look like relative to equities? What does it tend to look like during this period that we've been through recently? The value here, I think, again, for those of you particularly that haven't used maybe any alternative strategy at this point, it'll be good to set some context of what that tends to look like in practice. And for those of you that have, it'll give you a sense of how we think about periods like the one that we've gone through recently. So last thing I'll say, we're going to try to hold questions to the end after we get through both pieces because we got quite a bit of content to get through today. So we're hoping to have maybe about 10 minutes of question time on the back end. And of course, both presenters, me, will be up afterward for anybody that wants to come up with questions after we get going. So with that, I will hand it off to Yao Hua.
All right. Thanks, Jared. All right, thank you everyone for coming today. My name is Yao Hua Ooi. I'm one of the partners at AQR Capital. I've been with the firm for 15 years and I'm one of the portfolio managers of the style premia strategy at AQR that we've been running since 2012 in an LP format and a mutual fund format starting a year after that. So my focus today, I'm going to give a quick recap of what the fund's trying to achieve, what its goals are, what the underlying strategy is. And I'm going to spend most of my time talking a little bit about some of the analysis that at AQR we've been focusing on. Obviously the past year and a half has been challenging from a performance perspective for the fund. So we've spent a lot of time digging into understanding what the drivers has been behind the performance. A lot of that focus is going to end up focusing on the stocks picking or stock selection strategy, which is one of the multiple asset classes that we implement the strategy in. But we just wanted to give a broader context on what we've seen the past year and a half, and also give you a sense of on a longer term history. As AQR, we've been implementing style-based strategies for over 2 decades now. Even though the style premium fund itself is only about 7 years old, we've been implementing similar themes in many of our multi-strategy absolute return strategies for a much longer period of time. And so we wanted to be able to also speak to that as well. So let me start off with a quick introduction on what the strategy is trying to capture. So the style premium strategy is designed to be a market neutral, long and short strategy that tries to capture 4 major sources of returns that are long-term, share a number of different characteristics. So when we think about these 4 style premia strategies that are out there, some of them might be more familiar than others. Valuation is the first one. So just tendency for undervalued or cheap stocks and in other asset classes, cheaper assets to outperform more expensively priced ones, kind of betting on fundamentals long-term converging and prices kind of reflecting those. That's the first strategy or the first style that the strategy tries to capture. You have momentum, which has actually historically been a very good complement to value. It tends to actually be very negatively related to value. Typically, companies that look cheap on a value measure typically have had more difficult momentum recently. So momentum itself as a concept is a strategy that actually bets on recent outperformance, relative outperformance of assets continuing into the near past. And so typically the period that we look at for momentum is somewhere between the past 6 to 12 months. And we tend to find empirically a very strong evidence across many asset classes that markets, asset classes, stocks that have relatively outperformed over the past 6 to 12 months continue to outperform for the next couple months on those measures. Importantly, within momentum for style premia, we're not just going to be looking at price momentum, but we also have measures of what we call fundamental momentum. So looking at underlying attributes of companies or assets such as earnings or growth measured in other fundamental ways, and also seeing which of those have more recently outperformed, and betting that those names will continue to do well in the near future. The third style here is carry. So carry at its base level, you can think of it as what is the expected return that an asset is expected to give me if everything else stays the same about the world. So you can think of it simply, let's say for a currency asset, as typically this strategy would go long higher yielding currencies and go short lower yielding currencies. And if everything else stays the same about interest rates, about exchange rates, then you would expect to have a positive excess return generated by the high yielding assets and while you're going short to low yielding assets. This also can be applied across multiple asset classes. And lastly, we have defensive, which is another style that really focuses on exploiting this phenomena or this anomaly in some sense that when you look back at long-term historical data, there has been a preference for higher risk, higher volatility assets in multiple asset classes. We, as AQR, we've done a lot of research, written a lot of academic papers on this topic. We do believe that's tied to, in some sense, the investor's preference to not take on explicit leverage. So investors many times, because they have a need to get high returns, but they don't want to use leverage in their portfolios, they tend to gravitate their holdings toward higher risk, higher beta assets. And that leads to some systematic overpricing of those assets relative to lower beta, lower risk assets. And so the strategy here within style premia on a systematic basis actually tries to go long those lower beta assets and short the higher beta assets. And so over the long term capture a style premia from benefiting from that mispricing. So all four different styles, I think the characteristics that they share is that there's been a lot of academic research that's been done on all these four styles. AQR itself, being a research intensive institution, has ourselves published a number of the key papers looking into both the theory as well as the empirical evidence surrounding the four major styles here. And actually more recently, we've also been putting out some pieces, a piece that looks at the performance of these four styles going back as far as we can get data for, so looking at some out-of-sample data, more using longer-term past returns, and we found that the evidence behind the four styles is all quite robust. So I think that this is very important. We really take an academic and systematic approach in constructing this fund and investing the assets in this fund. And so even though at the moment we've been going through a difficult stretch of about a year and a half in this strategy, we do rely very heavily on the research that looks at a much longer term context to really put even more recent drawdowns in perspective. And what we found by and large overall is that there's nothing that we've seen about the recent performance, the recent environments that suggest to us that something fundamentally has changed about these four styles and their efficacy going forward. We do believe that the strategies, each and of themselves and also in combination, do have periods of good performance and bad performance, just like any investment strategy would. It's no different. None of these strategies standalone are extremely high Sharpe ratio strategies that you don't expect to see drawdowns happen from time to time. So, but I think it's important to also dig into some of the unique things about this particular period, and that's what I'm going to spend time on. Another quick thing about the portfolio construction that's also important, just to be clear, even though more recently we've seen a lot of the losses come from a particular asset group, which is the stock picking strategy within the fund, and also in particular within the valuation theme within that segment, it's really important to note that the strategy by design is created to be very well diversified across both styles and across multiple asset classes. So you can see that we have 5 major asset groups that we implement these styles in. There's stocks and industries, which refers to individual stock picking. Equity indices, which refers to a strategy that goes long and short individual country level index level. So for example, going long the S&P or the FTSE versus being short the Australian market or the Japanese stock market. Fixed income, which looks at both longer term bond futures, 10-year government bond futures across multiple developed markets, as well as shorter term interest rate futures. Currencies, looking at a basket of global developed currencies, as well as commodity contracts, so looking at multiple liquid contracts, futures in the commodity space. And the risk allocation that we give to the strategies are relatively equally balanced. We do have a little bit of a tilt toward stocks and industries because we find that that is the one area that we have the most breadth. There's the most ability to do cross comparisons across industries, and more importantly, across stocks within industries. That's where we actually take the bulk of the risk within style premia. And then on the sort of risk allocation side for the styles, it's not exactly equal. The reason of that is because not every style applies equally to every single asset class. For example, there are some asset classes where certain styles are excluded for a number of reasons, but by and large, you'll see that our general construction framework is to try to be risk balanced. And importantly, we also believe in a long-term strategic approach in harvesting these style premias. Sort of the idea is that in and of themselves, each of the individual styles within each asset class, we expect to have a good long-term positive return, even if with a modest risk-adjusted return, but positive. And importantly, all the individual subcomponents tend to have low correlations to one another on average. And so what we're trying to benefit from really at a portfolio level is trying to harvest many different underlying return sources, each with a modest risk-adjusted return that's positive, and very importantly, both diversifying to one another, and then maybe most importantly, when you roll it up at the portfolio level, the return stream that we expect to get from the style premia strategy overall is historically has been pretty much uncorrelated to traditional stocks and bond markets. And that's a really important characteristic that by construction and even on a day-to-day basis, we really emphasize. So this is the strategy's performance that we've seen since our inception. As I mentioned, this is the LP track record. The mutual fund started about a little bit over a year later, but has had very similar returns to the LP in the overlapping period. So when you look at the overall performance, we've realized something like a 0.4 Sharpe ratio throughout this entire period. That is a little bit lower than our long-term expectation. We do think the strategy is capable of realizing something closer to a 0.5 or 0.6 risk-adjusted return. So it's coming a little bit lower than that. Clearly, you can also see from the cumulative return graph up there that we've had a very meaningful drawdown since the beginning of 2018. That obviously also affects the long-term statistics of the fund. Prior to the beginning of 2018, we actually saw the strategy exceed its long-term risk-adjusted returns expectations. But very importantly, also the correlation to global stocks and global bonds has been very close to zero, and that's something that we actually very much think is just as important as achieving a positive risk-adjusted return over this period. So kind of diving into that last 18 months or so where returns have been more challenging. I'll give an example. This is the way that we tend to look at attribution. So we'll show on a regular basis the contributions that add up to the fund's overall return, which is, for example, in 2019 through September, about -5% or so. We'll break it down into the subcomponents, which again, left to right, you'll see the asset groups. And top to bottom, you'll see the different styles. As I mentioned, not every single style applies to asset groups, so there are a few little gaps there, but by and large, you can see that we have meaningful contributions coming from all the different components here, and that, again, these subcomponents tend to behave in a fairly uncorrelated way. For the past 18 months, really, a lot of the losses and emphasis has come from the stocks and industries portion. Again, this is a strategy where, for the most part, most of the risk we're taking here is looking within individual stock industries, within healthcare, within financials, within individual sectors, using valuation, momentum, and defensive measures to identify stocks that look like they're undervalued, that they have recently been improving in terms of price and fundamentals, and have good attractive quality and low beta characteristics. We tend to go long those stocks that sort of hit the sweet spot on all three measures. and we go short the companies that are the reverse. And the combination of these strategies has unfortunately yielded a fairly negative return over the past 18 months. 2019 is no exception. You'll see that the sum of the returns here, much more than makes up for the return of the fund overall. And that's what we've actually observed in the past 18 months, that the losses coming from stocks and industries have actually, accounted for pretty much all the losses in the fund. The remaining asset groups have actually behaved in a more normal fashion. By and large, for example, in 2019, most of the other asset classes have been very diversifying to stocks and industries. They have produced positive returns that have offset some of the losses coming from stocks and industries. And then within stocks and industries in particular, the value and momentum combination has been what has really hurt us over this period. The defensive strategies has actually continued to do very well over the past 18 months, and that has helped offset some of the losses from value momentum. But when we look at sort of the strategy or sub-strategy that focuses just on value momentum, we'll see that the past 2 years, really, or a year and a half, including not this year's not over yet, really reflect the toughest 2-year period out of the last 20, where AQR, this is in some sense using AQR live performance from our LPs again, because we've been running value momentum strategies in some of our other portfolios for actually well over 2 decades now. You'll see that when we look at the long-term performance of the strategy, that the last 2 years do stand out as being exceptionally difficult for the strategy. And to take a step back, at the end of the day, even though we're using these factors to try to identify what we think of for value momentum, cheap and improving companies, going long those, and going short more expensive and declining companies, that strategy tends to pay off in the long run, but has really suffered the last 2 years. And you can really ask, at the base level, there's generally 2 reasons why a stock picking strategy can do poorly over any stretch of time. One is that we could have been getting the fundamentals incorrect. So it could be that we thought these cheap and improving companies were going to outperform on a fundamental basis relative to the more expensive and declining companies. But it turned out that we were surprised because the fundamentals actually deteriorated in a much more severe way for the stocks that we were long versus the stocks that we were short. So that could be one possibility, and we've tried to analyze that and look quite carefully at that. And we really don't see that so far. So for example, when we look at one measure, which is, when we look at the basket of stocks that, again, have good value and good momentum, the stocks that we tend to be long more often, we look at the percentage of times those stocks outperform or surprise positively on a fundamental standpoint on their earnings. And what we tend to see is that the percentage that we've seen in the last 2 years of these stocks outperforming their estimates has actually stayed quite consistent with the past. So that in itself has not really been the source of the more recent drawdown. So it's really been the second factor that is another thing that we've also spent time looking at. And that really is what the market's valuation or the multiples that the market has put on different types of stocks. And this is something interesting that we've spent a ton of time analyzing and what jumps out to us as being very unusual about the last 2 years. So for example, there are 2 fundamental characteristics about the equities that we've looked at amongst many other factors that have looked unusual over this period. So one, these 2 measures are related. One is looking at average analyzed returns for US companies based on their R&D intensity. So how much do they pour into R&D? And then also US companies that have negative cash flows. And when you look at these 2 measures, over the long term, let's say from 1980 till the present, generally speaking, companies that have negative cash flows tend to underperform the broader market. That's probably not too surprising. And companies that have more intensive R&D intensity tend to have relatively muted, similar performance to the rest of the market. However, over this drawdown period for valuation and momentum in combination, we've seen that these 2 characteristics have actually been positive predictors of performance. So in other words, companies that have had intensive R&D activity and in some ways been burning through cash more aggressively have actually been heavily favored by the market. And that is unusual. When you look at, again, the past 40 years or so of stock return data, the only other period where you see a similar phenomena, and in a more extreme way, was the technology bubble back in 1999 and 2000, where there obviously was also a kind of focus on companies that perhaps were more in a had more disruptive possibility, and were basically spending a lot of money now to try to prepare for possible kind of taking up a lot of market share in the future That ended up not panning out as we knew the technology bubble ended up collapsing afterwards. And this period, there are some shades of that preference for this type of future growth. And we see that also quite directly in another, from another measure, which is looking at growth rates or growth measures for different US equities. So here we're looking at sort of three different measures of growth. These are earnings growth related measures. The first one is actually one that we do bet on directly. When I mentioned that momentum is one of the main themes for style premia, one of the things that we look at is, for example, going long stocks that have had better one-year realized growth and going short stocks that have worse one-year realized growth. That tends to be a positive returning strategy on average, historically. But over the past year and a half, it's actually suffered quite immensely. So for whatever reason, markets have actually punished those companies that had more recent, stronger growth. And on the opposite end, when you actually look at long-term forecasted growth, so this is analysts' estimates of stock earnings growth going beyond 1 year. Typically, they forecast out between 1 and 4 years. That historically does not have any predictive power for forecasting returns, and it's not something that is in our model because, empirically, we don't historically see much of a case for including the factor. That has actually performed extremely well, sort of at its 99th percentile relative to history. Basically, companies that have had the highest forecasted long-term growth have outperformed companies with lower long-term forecasted growth by an immense margin over the past year and a half or so. And so that, again, is another sort of sign, or at least to us, driver of why value strategies have suffered, and even our momentum strategies have suffered. We tend to focus more heavily on shorter-term momentum, and our value strategies tend to have a pretty negative relationship with these long-term forecasted growth measures, which have performed very well more recently. And I think another thing that's really unusual about this period is that these long-term forecasted growth measures, we don't show it here, but historically the market hasn't really priced it in too much historically. It hasn't actually panned out to be a very good predictor of stock returns because the growth forecasts actually have pretty low accuracy. You can imagine that the accuracy for analysts predicting 1 year out returns is fairly high. You can model cash flows, earnings to a pretty accurate degree. But once you get beyond a year, it's pretty difficult, and obviously there's a lot of surprises and shocks in the economy that are hard to forecast. And so when you actually look back, for example, the measure that we've looked at, the long-term forecasted growth assumptions versus what ends up getting realized is something on the order of about 0.2. So the accuracy has been fairly low. So not something that typically the market pays a lot of attention to, but in this particular period has been very much heavily emphasized. And so overall value strategies have been hurt by this strong preference for disruption, strong preference for long-term growth. When we look back historically, we don't see those factors really being rewarded, but it's been unusual in this particular period for them to kind of have such an extreme performance. And so we do think that that has, in some ways, both affected value momentum strategies in a negative way, but also set up potentially a good opportunity to the extent that some of this is overdone and corrects in the next year or couple years to come. It does set up a possibility for these traditional value momentum strategies, again, which have a good long-term track record, to recover. And one of the measures we tend to look at in terms of just forward-looking measures of how attractive right now valuation is after the losses is incurred is something we call the value spread. So the value spread just measures the level of cheap versus expensive, how wide that divergence is in the multiples. And here we're looking at it within industries. Again, that's because most of the risk we're taking in this fund is doing within industry comparisons. And what we see basically is that across US, emerging and international markets, that the value spread today is somewhere between the 90th to the 98th percentile. It's most extreme in emerging today. In developed markets, it's closer to the 90th percentile, which is a fairly high level. It's not as extreme as what we saw in the tech bubble, but there are some similarities. And while, as AQR, we're very clear that we can't exactly know when this is going to peak and when it's going to revert, historically what we've seen is that high valuation spreads tend to be conditionally a good period for value strategies going forward because the value spread does tend to mean revert over time, as you can see from the graph here. So while we don't have a crystal ball and we can't say for sure when things will start to turn around, We do believe that the underlying style premias are sound. We have not seen any reason to believe that something fundamentally has changed about them. The market definitely has sort of a very strong preference for a certain characteristic that we haven't seen for quite a while now since the tech bubble. But we think the strategy is well set up for success going forward. And sort of in conclusion, just on this section, I did want to show some longer term data of the style premium strategy itself, and just point out that this current drawdown does represent one of the steepest drawdowns that we have experienced. It's the largest live drawdown by far. But even looking back at a back-tested return of the strategy going back to 1990, it does stand out as the second largest peak to trough drawdown that we've seen. The last one that we saw, the largest drawdown that was pretty similar in magnitude, was actually from September 1998 to February 2000, so sort of doing the run-up, the extreme run-up piece of the technology bubble. And there were some similar kind of characteristics there. Again, valuation strategies were one of the main driving losses within the overall attribution. The strategy then went on to recover those losses as the technology bubble collapsed starting in March 2000. And then, sort of we haven't seen something similar in magnitude till the present. So, again, at AQR, every time, we don't necessarily expect the same exact scenario to play out. We're not forecasting a big market crash necessarily. And again, the extremeness of some of these valuation measures is not as severe as the technology bubble. But we do think that in a broader context of a strategy like style premia, it is a strategy that long-term has delivered a very solid risk-adjusted return. It does have periods, and we will go through periods in the future, where meaningful drawdowns will happen. But we think that that's sort of because of the lack of correlation, especially these drawdowns tend to occur at very different times than traditional stocks and bonds. And the good periods for the strategy also tend to happen sometimes at more difficult times for stocks and bonds. That's really what makes the strategy a very good component of a diversified portfolio. And so that is why, overall we are very confident that this approach to harvesting a diverse set of risk premia applied to multiple asset classes will still be very helpful to giving your overall portfolios a smoother ride going forward. So I'm going to stop there, just out of time, and let Dan sort of continue this part.
Great, thank you, Yao-Hua. Okay, as Jared said, I'm going to go extremely high level here. The slides I'm going to share with you are ones that hold not just for AQR, but really anytime you're going to do something different. It could be alternatives, it could be diversification in general. And so feel free to steal these slides. These are ones that I've sort of designed in order to be as broadly useful and relevant as I could get. Okay, so we've got kind of two things I'm going to cover. I know that the vibe of events like these tend to be pretty positive, but I'm going to start with a very nihilistic question, and that is, why bother? Why bother being different? Why bother doing anything besides just passive 60-40? And that's sort of a surprisingly complicated question to answer, as I'm sure you all know, but I'll provide you some data that I think gives a pretty good reason for why you should try to diversify. And the second thing I want to do is just sort of set expectations a little bit, because this is something that is just by definition hard to get an answer on, and that is, when is being different going to look good? And that's really the objective when it comes to diversification, when it comes to alternatives. All right, so let's get started. For students of history, this is the 10-year real return of a US 60-40 portfolio, and I'm going way back in time here. So this is 1900, I guess July 1900, and I'm just going to go forward 10 years. These are real returns, so this is excess of inflation. So this is, you get a sense of, this is sort of my purchasing power for being a traditional 60-40 investor over 10 years. Okay, so here's the first path. You can see being average, being 60-40 got you 42% over these first 10 years. You probably know exactly what I'm about to do. I'm not going to end this at 1910. I'm going to draw a 10-year path for every single year, starting from 1900 to 1910. Then I go 1901, 1911, etc. Okay. I've got a story for every one of these. No, I'm just kidding. I'm not going to go through all these lines. But what I do want to draw your attention to is how many of these lines go below zero at the end. I think that that's inconceivable today. If you were to tell your clients, hey, there's a chance that stocks and bonds over 10 years are going to end up losing you. You'd be better off just doing, say, T-bills. About 1 in 6 of every decade of cumulative returns for 60/40, you lost purchasing power. I think this is something that would really blow a lot of people's minds. But this is what a 0.3, 0.4 Sharpe ratio strategy looks like. 60/40 has been about that historically, and about 1 in 6 times over a decade has actually lost you money. Okay, I'm gonna be accused of being like the biggest pessimist in the world after this presentation, so I'm gonna try not to dwell too much on everything below the equator there, but I will go to the average. On average, 60/40 investor has made 70% real cumulative over a 10-year period. All right, if you see in the little legend there, I'm ending at June 18. Of course, you probably know what the next line is gonna be. The last 10 years. What's the most recent 10 years? It's this blue line. How was 60/40 done? Great, 130% cumulative returns. And I think this is how a lot of investors, a lot of clients think when they set expectations. They say, well, what's happened recently? That must be what's normal, right? All right, I'm going to try to quantify this a little bit further. How good is 130 compared to 70? Well, one thing we can do is we can compare the past 10 years versus history. And that's what I have here on the left. This is in terms of just returns. On average, you can see a little bit over 5%, and these are real returns, so this is excess of inflation. And I'm actually kind of put a pin in that number. I'm gonna come back to it. That sort of CPI plus 5 or real 5 it's an interesting number because it's the benchmark for so many institutions and individual investors, endowments across the country. How have we done lately? Well, that's the light blue bar here. Pretty well. Not like the best we've ever seen. 75th percentile, anyone would certainly take it. All right, this is one view of what it's been like to be a traditional investor. The next is in terms of risk. The audiences usually wince when I say risk and then I show them volatility. I recognize that nobody thinks volatility equals risk. There's other ways of thinking about it, and I'll show you another way. But there is sort of an interesting facet to the data here. 0th percentile. From a volatility standpoint, we have never seen a time as easy to be a 60/40 investor as we've seen in the past 10 years. Now, this raises a real challenge for diversification, be it alternatives or be it into anything. For investors who diversify as a way of reducing risk, the likelihood of them actually being successful over the past 10 years is about as low as it's ever been. You got extremely low risk just for doing nothing, just for being kind of your average investor. Okay, the last one, you could probably guess, I'm just going to take the left chart and divide it by the right chart. So this is the risk-adjusted return or Sharpe ratio. This is a supremely high percentile number. Your compensation for bearing market risk, just traditional stock bond risk, has been nearly as high as it's ever been in recorded history, going back more than a century. Another tough reason for being a diversified or an alternatives investor, if you're trying to improve your risk-adjusted returns, good luck. You couldn't have picked a worse 10-year period to do that. And again, that 0.4 Sharpe ratio for 60/40, that means 1 out of 6 10-year periods, you actually lose money. Okay, I'm going to come back to the risk thing. I mentioned no one really thinks of volatility as being the same thing as risk. So another way of thinking about risk is, well, what were my peak to trough drawdowns? That was one of Yaohua's latest, his last slides there. Over the past 10 years, this is what it's been like in terms of what was my max wealth versus the lowest wealth I've had over that period. Peak to trough, let's see, Q4 of last year. This was sort of a dreaded period to be an investor. Looks like he lost about 8% over that period for being US 60/40. When the picture is scaled to this, when I sort of bottom it out at -10, it does look pretty spiky and pretty scary. But let's put this in context. What has 60/40 been like historically? This is the magic of my analyst sort of animations, that would have to be the size to get it to scale, okay? We have seen nothing like the risks that 60/40 has typically seen over the past. There have been no tail events, there have been no black swans over this period. Just another indication of just how easy it is to be average and how difficult it's been to add value. All right, that's the past 10 years. I want to now ask, what does that mean for the next 10 years? And I'm going to kind of describe three scenarios. The first scenario is the 10 years we've just enjoyed tell us something about the next 10 years, that there's a positive relationship there. And I think this is how most humans are wired. You know, if you've had a good kind of performance, you kind of expect the next one to also be good. You would expect a chart to look like this. If I were to plot what were the last 10 years returns versus what are the next 10 years returns going to be, you know, it's upward sloping, so that means good past equals good future. Okay, for any contrarians in the room, I imagine as value investors, most of the room probably is wired this way. This is what you would expect. Scenario 2, good follows bad, bad follows good. So last 10 years, positive, so you're out onto the right here. What does that mean for your next 10 years? Negative, low. Okay, scenario 3, for all the people who love noise out there, scenario 3 is we have no idea. Okay, past 10 years don't matter. It doesn't tell you anything about the next 10 years. So which is it? Here's the actual data. It looks a lot like scenario 3, okay? In fact, if I were to draw a line with where we've been over the past 10 years, it would be right here. And the way to interpret this line is, okay, this is what we've seen over the trailing 10 years. It's been good. What does that mean for the next 10 years? Well, looking at history, it doesn't tell you much. You could get lucky at the top of that bar there, and you could have another 10% average return for 60/40. You could have, if you look at that bottommost line on that dot on that line, you could have negative real returns for 60/40. For those of you who are curious, this sort of lowest observation here was the 10 years prior to this one. And so, you know, to the extent you're saying, yeah, Dan, we really love your 1900 data, but I've got news for you. Markets evolve. Why would you ever look at the data going that far back? Well, in that case, you'd probably put more weight on observations like this, because that's what we've seen kind of more recently. For those of you who are curious, this sort of best case ever outcome, this was shortly after the end of World War II. Okay. I'm going to top myself in terms of depressing content, and I'm going to tell you what is the expected real return for 60/40. So I've basically so far said the past 10 years have been great. That tells you nothing about the next 10 years. I'm going to go out on a limb and say, okay, well, I think I know a little something about the next 10 years. What I'm showing you here is the real yield of a 60/40 investor. You can think of this as sort of just being the return you get just for showing up. Okay, and I'm plotting it through time. Of course, we're ending here at the far right. This is what it's like today. This is what markets are really priced to offer. If you believe in mean reversion, then your expected return should actually be even lower than this. This is a real return, so this is excess of inflation. What do we find? Well, for investors who have this sort of 5% return objective or target, we're about as far away from that as we've ever seen in history. One of the sort of particularly pernicious elements of the current environment is both stocks and bonds are expensive. You know, typically, if you were to go back to kind of on the left of this chart, there have been times where one asset class has been expensive, but the other hasn't really been simultaneously expensive. What's sort of nefariously special about today is that both are expensive, kind of leading us to this low value. Okay, I want to go back to that 5% real. I showed you the 60/40 historically has given you about that just for kind of showing up. That is the return objective, this blue line, for many institutions, for many individual investors, for many endowments, et cetera. I think one of the reasons for it is that used to be a totally achievable objective. If you were to take the average of the green line, you get about 5% real. I think the challenge for today is that you're as unlikely to hit what you could have historically by not even trying as ever. And I can even quantify this. So let's say you want to figure out, okay, well, what's the likelihood that I just get lucky? You know, even though markets might be priced to offer me the green line, there's still a chance because of volatility, uncertainty, et cetera, that I could still hit the blue line. And so what I'm going to say here is, okay, well, what's the likelihood of that? So the way to read this is, if I have a 5% expected return, what's the likelihood that I get 5%? Well, it's a coin toss, right? You could get 5.1 or 4.9. And so regardless of how far out you go, it's 50%. You know where I'm going here. What if your expected return is lower than 5? Okay. I'm going to just get kind of pessimist of the year award here. I'm just going to look at this bottom line here. So let's say you think 2% return in excess of inflation. What's the likelihood of that actually hitting 5%, just for getting lucky? Well, it's not hard to get lucky over any 1 year, kind of a 1 in 3 chance. But the farther out you go, the farther you go to the right here, the more likely your expected return is something that you actually realize. Kind of the noise kind of doesn't grow as quickly as your expected return. And so we'd argue that the likelihood of hitting what for many is sort of a standard objective over the next 5 to 10 years is historically low. And so that would be kind of the question, the answer to the question of why bother. Okay, the second thing is, well, compared to the first thing, it's a lot happier. It's a lot more fun. So without further delay, I want to now describe what should you expect? How can you kind of communicate expectations for something that by definition is supposed to be uncorrelated, have nothing to do with the rest of your portfolio? So to illustrate this point, the first thing I have here is 2 random series. So I went into Excel and I just said, give me a random column of numbers, and then give me another random column of numbers. And I'm just going to call these daily returns. And now I'm going to let's look at 3 years worth of daily returns and just report what's the correlation between these two things, kind of every day looking back over the past 3 years. Okay, not surprisingly, it's about 0, right? I've told Excel, give me 2 random series of data. Now it wiggles around a little bit, right? There's always going to be some noise in randomness. And I'm just picking this sort of this little observation toward the end. Think of this as sort of the recent past. Correlation between these 2 random things, 0. Okay. I've never met an advisor who meets with their clients once every 3 years. So let's shrink the horizon to something that is more practical. Same exact random data. Now I'm looking, what are the 3-month rolling correlations? These are random numbers, right? This is something that is 0 in expectation. What do you find? Well, the exact same data kind of starts to bounce around. That 0 that we have at the end is now a positive 0.3. Okay, for those of you whose clients have your cell phone numbers, a 3-month check-in might be way too slow. What does this exact series look like at a 1-month horizon? It actually kind of literally goes off the charts at times. That 0% that we saw most recently actually looks like a positive 0.6. And so this is sort of lesson number 1 when it comes to random. Random involves both positive and negative correlations. There are what we call kind of streaks in data. There are times where something that's uncorrelated can look kind of more similar or less similar to what you'd expect, positively or negatively. So I'm going to sort of take this idea and now ask the question, okay, well, what does it mean in terms of returns? This is just a relationship. How often should a diversifier do well or poorly compared to the rest of my portfolio? Okay, I'm going to assume there's only 2 assets in a portfolio. This schematic, though, can be used for anything. It can be used for whatever portfolio your client is currently in versus whatever you're going to add to the portfolio. But just for simplicity, I'm just going to assume there's 2 things in the portfolio. My investor has 100% of his wealth in equities, and I'm thinking of diversifying, in this case, with a liquid alternative. Okay, so there's 4 possible outcomes that can happen to this portfolio. The first is equities do poorly, and the diversifying asset, the liquid alternative, does well. How does that feel? That feels great to be the advisor, right? You made the perfect call. You found a hedge. You got returns exactly when your client needed it. Okay, the next outcome, both things could do well, right? Stocks could do well, and you expect them to. Otherwise, why would they be in the portfolio? And the liquid alt could also have positive returns. Why else would you have it? You're probably not going to get a whole lot of credit for making the call to diversify, right? It's sort of like a rising tide lifts all boats. And so that's why I've got, what's the feedback you would get? Well, obviously, call me when something interesting happens. What's the next thing that could happen? Okay, well, equities could do well, and diversification could do poorly. I would characterize the past decade as this. Our compliance department called me and let me know. They said, "Hey, Dan, we have a question. What does this mean here?" And I was like, "Really?" I thought this was as universal a concept as I would ever find. It took a lot of back and forth for me to. I actually asked, "Was there a different way you'd like me to spell it?" Okay, this is, I would suggest, one of the hardest things to kind of survive, because it's like you took me out of something that's been working for something that hasn't. And the last thing is, what if both do poorly, right? This is I see this headline, diversification failed, at least monthly, and Jared even has a paper with a title very similar to this. And so now what I want to do is quantify how often and over what horizon should you be in each one of these quadrants. Okay, you're a genius. How often should you be a genius, or thought of as a genius anyway, for diversifying into something like a liquid alternative? Well, I've got various horizons here. The bad news is, well, it's a bit of a coin flip. If you have a 1 in 4 chance of landing in a quadrant, that's sort of your chance of being called a genius. It doesn't really go up over time either. The reason for it, of course, is you kind of expect you kind of expect not just this to do well, but you kind of expect this to do well. Okay, the next one. Well, obviously, duh. How could you lose money when everything else is doing well? The good news is it goes up over time, and I think everyone would expect that. That's what most people's intuition would be. What to me is surprising about this chart is even over a 3-year horizon, you have about a 50% chance of both things doing well, and that's sort of an unusually low number as far as I'm concerned, right? You think that two things with positive expected returns, 3 years, I mean, that's a long time for most investors when they think of, how long should I wait for something to kind of work? Okay, compliance's favorite. The good news here is the function goes down. The longer you have to wait for a strategy to kind of reveal its positive returns, the more likely it's going to, the less likely you end up in this sort of dreaded scenario. But over shorter periods, it's pretty close to a coin flip, 25%. And the very last, diversification failing. The good news is it's very much like that previous function. It goes down over time, but again, over these shorter horizons, it's still quite likely. Okay, putting all of these together here, this is something that I think is worth kind of warning or speaking with investors about before making any portfolio. It doesn't have to be liquid alternatives. It could be any diversifier. Are you able to survive the heights of each of these bars? I think if the answer is no, it's probably not worth doing, because what would happen if the answer is no is you're probably going to be forced to sell something at the wrong time. You're probably going to be forced to sell something kind of when this happens, even though this is kind of what's expected to happen on average as you kind of go further and further out. Okay, I'm just going to gloss through this really quickly. This is the exact same kind of 2x2 framework, but instead of looking at a hypothetical liquid alternative strategy, I'm actually going to use data from that first section. So this is stocks and bonds. I think a lot of people say why should I bother with diversification? I've already got bonds in my portfolio. Okay, well, this is looking over the past 20 years. This is real data. How often has it been that when equities have done poorly, so we're on the left side of each one of these 2x2s, how often has it been that bonds have done well? In other words, how often have bonds performed as a hedge? And so these green numbers are just what's the top, right? Hedge, bonds do well, stocks do poorly, divided by how often you're in this area where stocks do poorly. Over the past 20 years, bonds have acted like a hedge. I mean, if you look out at kind of 3-year periods, every time stocks have lost money, every time you're on the left, bonds have made money. And I think this is the intuition a lot of people have developed in terms of the role of bonds in a portfolio. Okay, you guys know that I had 100 plus years of data. I'd be remiss not to show you what it looks like. If we look at all of history, though, you find kind of this different phenomenon. Bonds haven't always had this sort of negative correlation with stocks. If we look at kind of the full history, you find, well, bonds act quite a bit more like a diversifier than a hedge. When equities are down, when you're on the left side of any of these 2x2s, you have kind of a 50-50 chance of bonds doing well or doing poorly. This is sort of another reason for why you want to get kind of as many diversifiers in a portfolio as you can. Okay, I'm going to end on just, I think this is something that everyone kind of intuitively knows, but it's one of the, sort of the behavioral tics that investors have a hard time ridding themselves of, and this is this notion of line item thinking. When it comes to evaluating whether or not something is doing well or poorly in a portfolio, they just look at it kind of standalone. And the problem with that is, if you only have 5% of something in a portfolio, the standalone performance doesn't really tell you anything about how it's actually impacted your overall wealth, your overall portfolio. And so line item thinking is just thinking of things more in sort of an attribution perspective. How's its return? And the size. And another thing you think of is, well, how has it done in terms of diversification? Was it successful in doing one of the things it was supposed to do, either improving risk-adjusted returns or reducing volatility? I'm gonna skip the rest of this in the interest of time. I'm just gonna mention one of the things that my group is, one of our main objectives is just to be a resource to folks like all of you. We have a number of analytical tools, like some of the pictures in the presentation today. If you have questions in terms of the role of alternatives, the expectations for them, that's sort of the bread and butter of my group. The last thing I'll mention here is our investor-friendly content. If you can already tell my voice is annoying, then skip the middle paragraph here. We have a podcast at AQR. The idea is to bring some of our more technical content to audiences that aren't really interested in reading a 70-page academic paper. We had one of Jack Bogle's last interviews was on our podcast. The 3 episodes that I have listed here are the ones that are kind of most relevant to the topics Yao and I have spoken about today. Those would be kind of the first 3 to check out if you're interested. And the last thing is we actually have old school printed paper in terms of content that would be helpful for end investors when it comes to diversification and liquid alts. Okay, so I think with that, we've got, still have time for questions. Yes, yeah, and that's a good way of putting it together. Now, the way I built this was I said, the hypothetical liquid alternative here, I'm gonna give a 0.5 Sharpe ratio, so 5% return, 10% vol. The equities here, I said 5% expected return, 15% vol. You could put in whatever your expectations are, though. This is a fully kind of dynamic thing. So if you were to increase or decrease, the risk-adjusted return or return expectation, everything can kind of flow through. Yeah. And by the way, it'd be the same thing if instead of having equities on the bottom, you could put an entire portfolio. If you said my expected return for this portfolio and expected volatility for the portfolio is X and Y, then the whole thing could be updated to be, sort of as custom as possible for a real portfolio.
This may be an unsophisticated question, but since the BAM portfolios tend to be value tilted, heavily value tilted, are we not tripling down on value premium and maybe overexposed to that premium by including style premium as our all?
Yeah, so I think importantly, when we went back to the construction of style premia, value is only one of the 4 style premias. The remaining asset classes and also asset groups, importantly, are quite diversifying. So again, I imagine most of the BAM portfolio's value tilts in equities primarily, but we have value in commodities, value in equity indices, currencies tend to have not as high of a correlation to value in equities to begin with. But I think importantly, the rest of the portfolio tends to have a lot of allocation to the other 3 styles that are not value, especially something like momentum, which is very highly negatively correlated. So one practical thing that we were just talking about before the presentation, if you look at the returns of style premia relative to the value tilt in many of the other value long-only equity portfolios, the excess value tilts that you get, over the full period, longer term, you tend to see almost a 0 correlation between the style premia overall group of returns versus the value tilt excess returns coming from that piece. And that's because by portfolio construction, the diversification from the multiple asset classes and the multiple styles lead to that conclusion. Now, over the past year and a half, clearly it's shown up more. But for example, I like to point out that in 2017, value also had a pretty tough year. Overall in long onlys, in style premia as well, but many of the other styles in the style premia fund had very positive returns, and so that actually ended up being a significantly positive return year for the style premia fund in 2017, even though when you looked at that attribution grid, the sort of stocks and industries value piece itself was pretty highly negative as well. So that can happen.
Yeah, and I can speak to that directly, knowing the BAM portfolios intimately. So we've actually looked at this, looked at the returns in excess of the total market for, say, our risk target 3 strategy, which tells you basically what's the size and value tilt actually doing, how it's performing, compared to style premia, and yet there's really no correlation there. Again, you can see it over shorter periods of time, but when you look at the full history, you don't see a significant relationship there. And that's primarily, I think, because there are lots of other things going on here besides the equity portion of what the fund is doing.
And I'll add to that as well. Even within stocks and industries, we do have a pretty high focus on industry neutral, so meaning not taking industry bets for the most part within style premia. That's also one major difference that leads to probably a lower correlation than most long-only value implementations, which tend to have a decent amount of industry bets embedded within it.
So got time maybe for one question if we have it. Any others? Okay, last thing I'll note, thanks to Dan and Yaohua today for being able to present. One thing I'll note, I did note off the top, for any of you that have not used style premia, we went obviously fairly deep today. There are a lot of other materials either that we produced or that AQR has produced. I know Dan covered some of those in terms of like a 101, 201 level introduction to the strategy. So if you're not familiar with any of that, interested in seeing that, feel free to hit me or other stuff on that. Otherwise, we'll hang around a little bit. If there are any other questions that come up.